Okay guys, so in today's video I want us to do a ratio analysis, or we can also call it analysis and in an interpretation of financial statement. So in this video I'm going to break down 4 components that you have to understand first before we go to the calculation, so that you will be able to comment whenever the ratio that you will be required to prepare. All right, number one, you must first understand the word profitability. Alright, so if you are talking about a profitability, of course, when we calculate any ratio that falls under profitability, we want to check if the company is making any profit, or if the company is in a good condition to control their incomes and expenses. So when we analyze all the profitability, that's what we want to know. So which means that if, for example, we are calculating a net profit on sales, we want to see if we are making a good enough. So you also have to make sure that you know a norm by each and every ratio that you are going to analyze. So we are going to go through that when we go to the question. So you also have to understand number two, which is liquidity. All right, so when we analyze liquidity ratios, we actually want to see if the company will be able to settle a short-term or a long-term liabilities. Remember, as a company, it's not everything that we purchase in terms of cash. Some of the item we purchase in terms of credit, which means that we go and borrow to our supplier. So before that, the company that we are borrowing to, they're going to check under liquidity if we will be able to pay the short-term liabilities or the short-term debt. So we have different formulas that fall under liquidity that we are going through to analyze it. So you also have to make sure that you know a norm of each of and every formula under liquidity. All right, so the next one that we are going to is solvency. Okay, number 3 is solvency. So when we talk about a solvency, it's similar with liquidity. However, what you have to know is that liquidity is all about a short term, okay, and liability solvency is about a long term. Simply means that when we deal with a solvency, we want to see if we're gonna be able to pay a long-term liabilities. A liquidity is about if you will be able to pay a short-term liability, which means that each and every calculation that you are going to make, you must be able to comment whether the company will be able to pay or not. All right, then the other one that we are going to deal with is the returns. So it's very important to also calculate if the owner is going to be satisfied with the return that the owner have. For example, we can calculate, maybe we get that the owner is getting the 20% of the return. So you must be able to comment if the owner is going to be satisfied or not. How do you comment? Let's go to this part now. How do we comment? Very simple. When you comment the first part, number one, you must be able to compare a result of the previous year. Okay, you compare previous year results. Okay, let me give you an example about the return of the owner. Let's say on the previous year the owner was getting 40% return, and this year is getting 20%. Is he going to be satisfied with the return? Obviously no, because there is a 100% decrease, almost a half. Okay, there is a half of decrease from 40% to 20%, which means that the owner obviously is not going to be happy, because he's going to get a way lesser amount that he was getting on the previous year. But this is not the only option on how you should comment. Number two, you must be able to use a norm. a norm. Alright, so if you are talking about a norm, simple means that in this case you are not going to be given a previous year result that you are going to use to compare. Okay, so a norm is work like this. For example, we have a ratio under a liquidity, which is also known as current ratio. Current ratio. So basically this ratio have a norm of 2:1, which means that, in other words, the minimum that they're saying that is that a current ratio is more acceptable when the ratio is at least 2:1. If you get a result which, for example, is 5:1, simple means that it's more good, which means that the company will be able to pay what? A short-term debt. Okay, so but if the result is 1:1, which means that this is not acceptable according to a norm. But if you are given a previous year result, you can be able to have a two option to comment. Alright, so let's check the question paper that we are going to do. Alright, so on the question paper that we are going to do, this is the question that we've been given. Use the information given for Bailey to answer the question correct. Okay, and they give us a post-closing trial balance on 30 June 2019 and 2018. Okay, they give us tangible assets, fixed deposit, inventory, trade and other, receivable, cash and cash equivalent, owner's equity, mortgage bond, trade and other payable. Okay, and additional information, they give us a cost of sales, operating expense, and net profit. Okay, and 4.1, they said calculate the sales if firm use a markup of 50% on cost. How are we going to calculate a markup of 50% of sales? Remember, if we check the additional information that we have, we only given a cost of sales amount of 600,000. Okay, it's 4.1. We have 600,000, which we have to apply a markup. Okay, remember, we are looking for sales amount. A sales must be higher than a cost of sales, which means that our markup will be on top. Okay, remember, always is always 100/100, but because we are looking for sales, we must also add what? Our markup of 50%. Okay, which means that it's going to be 150 on top. Okay, but if we have sales and we are looking for cost of sales, 150 was going to be on bottom and 100 on top. Okay, then if you calculate this, let's calculate, it's gonna give you amount of 900,000. 900,000 is the answer for number 1. Okay, so yes, you must be able to calculate a sales because it might be required on the following questions. Okay, then number 4.2, calculate the return on average owner's equity, and should the owner be satisfied with the return? So which means that you must be able to do what? To comment. Okay, we are going to do that. So average on owner's equity, we have to use the formula which takes a net profit divided by average equity, and we multiply by 100. So when we said average equity, we simply means that you must add the balance for last year and for this year. You add them together and you divide by 2. It's going to give you a word average. Okay, then let's check. Our net profit in this case is 1/3. Okay, let's check our equity for last year and for this year. Okay, for last year it was 180,000, which we have added with the current year of 271,430. 271,430. Okay, you add them together and you divide by 2. Alright, then after that you're gonna multiply by 100. Okay, so if you do all this calculation, remember guys, as I'm saying it again, you must first add this 2 and you divide by 2, then you get the answer, then you divide. Okay, then it will give you amount, the percentage of 57.6%. Simple as that. Now it's time to comment. How are we going to interpret this? Is 50% good? Remember, in this case, we are not given any amount of last year, as you can see on the question paper. There's no any amount on the of last year. Yes, this is good. Why? A norm for return is 25%. If at least the owner is getting 25% or more, that's good enough. Okay, which means that the owner is going to be satisfied. Yes. Okay, another option, you can compare with the fixed deposit rate. Okay, as you can see, the fixed deposit interest rate is 10%, which means that a 57% is more good than a 10%, which means that he's going to be satisfied. Very simple as that. Okay, then 6 marks for this. Then 4.3, calculate the current ratio for 2019. Okay, current ratio for 2019. How do we calculate current ratio? Very simple. The formula that we are going to use is current asset is to current liability. Simple means that we must look for current asset, then we divide by current liability. So when we talk about current, simply means that it's a short-term asset and short-term liability. Alright, then let's go and check. The first asset that we have is tangible assets, but tangible asset is not a short-term asset, it's a long-term asset. When you buy a vehicle, you are expecting to use it for longer than 1 year. Simply means that it's non-current asset. Okay, we're gonna take that out. Then a fixed deposit, in this case, is non-current assets because it's not yet matured, which it can be converted into current, which means that even this one is not going to form part of current assets. But we have inventory of 54,070, which is current asset. Okay, 54,070, which we are going to add it with trade and other receivable, is also current asset, 34,700. Okay, let's check if we have another one. Cash and cash equivalent of 1,650 is also current asset, which means that you must add all these. Then you will get the amount of 90,420. Okay, then is to current liability. Current liability, we have to check on the bottom. We have a trade and other payables. Mortgage bond is non-current, we're not going to include it. Then trade and other payable of 26,654. Then now we can calculate. How do we calculate? You take this one and you divide by this one. Then you will get the answer for this side. This side is always 1. Okay? If you do all this calculation, you are going to get 3,4. Okay, now it's time to comment. Is it good or bad? Remember, a norm for current asset or current ratio is 2:1, which means that yes, company will be able to pay a short-term liability because we have this side is current asset, this side is current liability, which means that the company have more assets. They have 3,4 assets over each liability. Simple means that our assets are more, which means that we will be able to pay a short-term liabilities, which means that the company is in good condition and there is no risk of liquidation. Okay, remember, if it's go very down, there is a risk that the company can liquidate. Okay, then let's proceed to the next one. Acid test ratio. So when we talk about acid test ratio, it's similar with this one. However, we have to do what? We have to subtract amount of inventory. Okay, which means that, in other words, we're just going to add this 2, or we just take this 90,000 and we subtract inventory. Okay, let me write it here. 4.4. Alright, a formula for acid test ratio, it says that current assets minus inventory is to current liability. Okay, which means that our current assets in this case, okay, let me run this chart so that I can write proper. Alright, so which means that we're going to say it, a current assets minus inventory is to current liability. Alright, then our current assets that we got on the previous question, it was 90,000 and 420. Okay, then now we have to subtract inventory amount. Okay, then inventory amount, let's check. Inventory amount, we have 54,070 is to current liability of 26,654. Okay, which means that we have to calculate, we have to subtract this side first, and we get the answer. Then after that, it's gonna give us amount of 36 and 350. Okay, over 26,654. Okay, this side is always 1. Then if you take this one, divide by this one, it's gonna give you 1,4. Alright, so when we talk about acid test ratio, in other words, we assume that there is an acid in inventory. Like, for example, if you are a company that is selling bread, you can't say that you're gonna pay back the debt using a bread, because they are going to expire anytime. So that's why we have acid test ratio. So we want to test if we will be able to pay short-term debt without what? Without inventory. And the answer is yes, we can be able to pay, because a norm for this one is 1:1. Okay, we're above the norm, and as you can see, the asset is higher than what? Liability, which means that yes, the company will be able to do what? To pay short-term debt without inventory. Okay, then let's go to the next one. Degree of solvency. Degree of solvency. Alright, so the formula that we have to apply here is total assets is to total liability. So you must know the difference, guys, between a solvency and the liquidity. Okay, so when we talk about a solvency, we don't only measure a current only or non-current only. We measure total. Total simply means that it's non-current assets and current assets. Okay, then is to what? Non-current liability and current liability. Alright, which means that we have to check all our assets that we have. Number one, we have tangible assets. Tangible assets is non-current assets. Okay, we have amount of 222,000 and 66,004. Okay, then which we have to add it with 45,000 together with current assets that we were already calculated, which is 90,420. Okay, this is total assets. It's non-current and current assets. Okay, these two total liability. Total liability, the first one we have mortgage bond of 60,000 plus 26,654. Okay, then after that we must calculate the totals so that we can get the answer and be able to do what? To comment. Okay, so under a total assets we're gonna have amount of 358,084 is to total of current liability, which is 86,654. Okay, then after that we have to divide 358 by 86,000. Okay, this side is always 1. Okay, the answer that we are going to get here, if you calculate, is going to give you 4:1. Okay, now we have to comment. Are we going to be able to pay a long-term liabilities, or are we going to be able to pay liabilities as a company? Yes. As you can see, our total assets are more greater than the liabilities that we have, which means that as a company we will be able to pay what? Liabilities. So this is part 1 for ratio analysis and interpretation. So I'm going to bring more questions so that you can know the different style on how you should comment, how you should calculate all these kind of ratio. Thank you so much for watching, guys. Don't forget to like and subscribe and comment. What do you think and which other videos do you want next? See you.